Welcome to The Savvy Investor, where it's our job to help you thrive in any economy. In America today, it can feel like there are two tax systems, one for the informed and one for the uninformed. Both are perfectly legal. Today on The Savvy Investor, retirement tax strategies.
Welcome to The Savvy Investor. Each week, The Savvy Investor helps viewers just like you create and grow wealth, protect and preserve it, and distribute it in the most tax-efficient manner while alive and after you have passed. Our goal is to make you a better informed investor that hopefully leads to better results, but certainly less risk along the way. You can have financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your retirement forever. And now, The Savvy Investor with your host, Michael Canet.
Good at math, say smarter than a fifth grader, and you can do simple addition and subtraction. You already know that we can't fix the national debt by just cutting spending. According to the Peter G. Peterson Foundation and former Comptroller General of the United States, David Walker, you can eliminate the entire federal budget. That's everything. Homeland Security, Defense, Housing, Energy, and even Congress, which quite frankly might not be a bad thing. But by at the end of the decade, you can barely pay for Social Security, Medicare, and Medicaid. You might have a little left over to cover the national debt and interest, maybe. So the question is, if you can't cut enough spending to bring the budget into balance, or even quite frankly, a semblance of balance, where does that leave us? Given that we are at historically low tax rate, does anybody truly believe that the government won't eventually raise taxes? You know, it always amazes me that when I hear people talking about how much they've saved in their retirement accounts, things like their IRAs, their 401ks, SEPs, 403bs, and even the TSP, you know, they've worked hard and did the right thing along the way because they knew if they're going to have the right retirement they imagined, it would take time and planning. Unfortunately, most people don't realize they have a silent partner in that retirement plan. For that matter, a partner in all your investments and assets. Think about this silent partner as if you were in a business. You do all the work, you take all the risk, yet your partner sits there silently waiting and quite frankly expecting and demanding their share. Who is that partner, you might ask? Of course, the IRS. They want their share. And think about this. Have you ever noticed that when you combine the words the and IRS, it becomes theirs? And it's kind of ironic, isn't it? So today on The Savvy Investor, our expert panelists, they're going to show you how to take control of your financial future and pay the least amount of taxes legally possible. Before we answer these questions, let's take a look at what's in the news. Our first piece comes from Bloomberg's Business Week, and it says, how to pay no taxes, 10 strategies used by the rich. You want to know why the rich stay rich? They pay the least amount of taxes legally possible. From Money Magazine, we have a piece that Buffett's still telling us that he's paying lower taxes than his secretary. Now think about this for just a minute. One of the richest men in the world, he's worth a little bit more than $44 billion. Do you think he has a strategy for paying the least amount of taxes legally possible? Absolutely. And from Forbes, they had a great piece on Puerto Rico. Puerto Rico pours on tax incentives for investors. Now imagine for just a minute, all your short-term, long-term capital gains, investments, real estate, dividends, interest, all tax-free. Today, we're going to help put you back in control of your retirement and give you the knowledge you deserve so you can make smart money choices and have the retirement you've always imagined. You're watching The Savvy Investor, and we'll be right back.
Call today to get your free guide to navigating taxes in retirement.
If you're in retirement or retiring in the next 3 to 5 years, you must read Michael Canet's best-selling book, Surviving the Perfect Storm. Best-selling author and National Quill Award winner, Michael Canet's Surviving the Perfect Storm is a must-read to prepare for your golden years. This amazing book can be yours absolutely free, but you must call 800-787-SAVVY. Supplies are limited, so be one of the first 25 callers to receive your free limited edition autographed copy of Surviving the Perfect Storm. Call 800-787-SAVVY.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. We're going to be sharing with you the tax strategies for today and as you go through retirement. If you think you're paying your fair share of taxes and the government does a good job spending your money, then this isn't the show for you. But if you think taxes are too high, you're going to want to stick around. But first, let's go to our man on the street, Mike Macho, and find out what others think about their tax situation.
Hi, Mike. We're taking it to the streets to see how people really feel about taxes. Are you concerned about taxes going up in the future?
Sure. Absolutely, as a small business owner.
I think taxes could probably stay pretty close to what they are right now. I'm not very fond of a lot of the uses of my tax money.
Do you think that that everybody pays his and her fair share of taxes?
No, I don't.
No.
Oh, no.
It's probably a yes and no answer for me, because I realize you have to pay taxes to have government entities to survive.
I actually don't mind paying some taxes. We could get out of paying school taxes right now, and we choose to pay school taxes because we happen to believe in education and that we all benefit from education.
Would you want to know more about being able to create a tax-free income in retirement?
Yes. Do you know somebody I can talk to?
Absolutely.
Okay.
Mike, there you have it, Mike, an uncensored view on taxes. Back to you in the studio.
Thanks, Mike. It sounds like people are really concerned about the future of their taxes. Now, imagine if we could help you create a strategy, help you create a plan that you could put in place today that would substantially reduce or even eliminate your taxes. Well, that's exactly why we have our expert panelists in today. We're going to show you how to pay the least amount of taxes legally possible. You're watching The Savvy Investor, and we'll be right back.
Interested in learning more about planning for your financial future? Join Michael Canet, host of The Savvy Investor and best-selling author, in person for an important, life-changing financial workshop on the following dates, and start taking control of your future. If you are ready to discover the financial tools and strategies that can help you build the retirement of your dreams, just call 1-800-787-SAVVY today to reserve your spot.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. Today, our expert panelists are Phil Calandra. He is the CEO and founder of Calandra Wealth Management. I'm also joined by Greg Jacobs. He's an attorney. He's the managing partner with Jacobs & King, and attorney Doug Lodmell. He is the managing partner of Lodmell & Lodmell. And we're talking about taxes and the things you need to be thinking about. And one of the things we were talking about, before we came aboard here, is that there's a big difference between having a tax preparer, because quite frankly, from my perspective, you can teach a monkey to put numbers on a page. That's preparing taxes. And a tax planning. That takes planning. That means meeting with people. So from the perspective of the financial planning world and the advising world, it's a little bit different than it is from the tax and the estate planning and asset protection world. But let's talk a little bit about that, the whole idea of making sure you're planning for your future taxes instead of just letting them happen.
Sure. Well, one of the key things is tax preparation is looking backwards. That's already happened. That's been in the past. Tax planning is looking to the future. And that's what a proper financial plan or investment strategy will do. It'll help you look into the future and identify those areas where you may be stepping into an area that you're paying higher and higher taxes. And there are strategies that any good financial planner and savvy investor can take advantage of, that they're not going to be paying a higher and higher tax liability in the future. Most people believe taxes are going lower, right?
Right.
So if taxes are higher in the future, we got to be looking in the future, not backwards.
Right, so the idea is to create an income stream tax efficiently.
Absolutely.
Now, one of the things people ask about all the time is the whole idea about the estate planning issue and estate planning taxes. But from an estate planning point of view and doing trusts and wills, it's not just the estate tax that you can actually do some strategies with. It's actually income today while you're alive, not just when you die, trying to protect the money for the future generations. There's tax planning you can do today.
Absolutely. There's all sorts of trusts are taxed at different rates, and there's different kinds of trusts, and so using trusts to sort of maximize the what I call the use of the brackets, which essentially is minimizing your taxes, which, as you said, takes a lot of planning. The other point that I would add that's real significant today, not just in thinking about the estate side, it's thinking about the preservation of the step up in basis and making sure that you keep that, which really goes to your income tax when ultimately assets are sold.
So the step up in basis being when we pass it on to the next generation.
Correct.
Right. So but let's focus for just a minute. If we're thinking about income, right? Because for most of you, you're at this point in your life where you're probably trying to figure out, how am I going to create the income that I need? And where's it going to come from, right? And we're trying to decide, do I take it out of this bucket? Am I going to, the IRAs are taxed different than Roth IRAs, than brokerage accounts. We have all these different tax brackets, which comes back to your point of are we doing tax planning just from income, or are we doing tax planning on a bigger scale? And obviously, if you're using trust, I mean, I think people are intimidated by trusts, but the fact is that they can be as convoluted as you want them to be, or they can be as simple as you need them to be. But when you're talking to people about income planning, how are you doing this in such a way that they're paying the least amount of taxes legally possible?
Well, I think you hit the nail on the head. Most Americans are getting to retirement and they have all these different accounts. They may have a Roth with a little bit, a 401k that's the predominance of their retirement money, and then maybe a brokerage or what we would call a non-qualified account. So the proper strategy has got to be to look at all the different accounts and then align them so that you have the most efficient income. Traditionally in America, we would start tapping 401k or IRA dollars at a particular time, 70 and a half. Well, maybe it makes sense from a tax perspective to start drawing those assets down earlier, delay the Social Security, build the investment plan around some specific tax ideas with all these different accounts. Obviously, the Roth IRA being the most valuable account you have, because it's never going to be taxed.
And the idea is that you're taking from these different asset buckets, trying to keep yourself in that next lower tax bracket.
Absolutely. Bucket planning, exactly.
And this feeds back into your idea of having, using trusts to pay the lowest marginal tax rate. So somebody that might be in the higher tax brackets, using a trust could actually save them a fortune.
One thing, too, to keep in mind is that when there's a large taxable event, and to plan in advance of that taxable event, to minimize the taxes is real significant. So when someone's looking at retiring and they're going to sell a piece of real estate or sell their business or create some sort of taxable event, minimizing that tax is always important to our clients. But the question is, did they come in to see us before that event happened? Because our options become much less after the fact.
Always the case, right?
Well, always the case.
Because, and I know you guys do, and I don't want to go into the whole Medicaid and all that side of things today, but I hear it all the time. Mom, Dad, Mom just went into the nursing home. What do I do? Well, come see me 5 years ago. Yeah. So Doug, I know, since we're talking about the income tax plan, and you and I have discussed this on numerous occasions, and I know it's narrowly scoped. But there's some strategies out there where you can actually, if you do it correctly, your dividends are tax-free, your capital gains are tax-free, your interest can be tax-free. I mean, there's all sorts of things that you can create. Let's talk a little bit about that opportunity.
Yeah, it is a narrow exception, but it is very interesting because Puerto Rico just passed legislation that allows for someone who's not a resident now to move down and become a resident, and effectively, if done right, have a 0% tax rate on their dividend and interest income. So it's very interesting because Puerto Rico is under the U.S. tax laws. So we're not talking about an offshore solution. We're not talking about Google or Apple, not paying U.S. taxes.
We're not talking about exotic stuff here.
It's not. It's not. That's the funny thing is it's actually kind of vanilla. It's not being talked about a lot, but it exists. It's fairly new, and it definitely has some very interesting pieces that if you have a lot of income, if you have, I don't know, $750,000 or $1 million worth of income.
Especially when it comes to dividends and interest.
Yeah, dividends and interest. Or if you have the type of income that could be shifted to where the intellectual work that's required to create that, say you're a hedge fund manager or you have some intellectual property that you lease, can be moved to Puerto Rico, that works as well. So it is very, very interesting, but still developing and quite new.
We're going to take a break here, but when we come back, I want to continue our conversation. I want to talk more about, there's some new rules coming down the pike for Roth IRAs, some new talk about traditional IRAs. I want to talk about that when we come back. We're going to continue our conversation. You're watching The Savvy Investor, and we'll be right back.
Call today to get your free guide to navigating taxes in retirement. Interested in learning more about planning for your financial future? Join Michael Canet, host of The Savvy Investor and best-selling author, in person for an important life-changing financial workshop on the following dates, and start taking control of your future. If you are ready to discover the financial tools and strategies that can help you build a retirement of your dreams, just call 1-800-787-SAVVY today to reserve your spot.
Want to lower your taxes by as much as 25% this year? If you think Uncle Sam is taking too much of your hard-earned money, it's time you did something about it. Our specialists and attorneys have over 100 years of experience helping hard-working retirees just like you. For a limited time, we're giving $99 income tax preparation appointments to everyone who calls and mentions this offer. Our licensed team of professionals can help assist you with sound tax planning, financial planning, and investment management. Taxes are too important to let just anyone prepare your returns.
Call ProStatus at 800-787-SAVVY or visit ProStatusFinancial.com to ensure you get all you've earned.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. Today we're helping you take control of your retirement. You deserve the retirement you've imagined, and we're going to help you get there. There's a great quote by Arthur Godfrey, and it goes like this: "I'm proud to pay taxes in the United States. The only thing is, I can be just as proud for half the money." Today we're joined by financial advisor Phil Calandra, estate planning attorneys Greg Jacobs and Doug Lodmill, and we're going to help you reduce your taxes to the lowest amount legally possible. Now, before we go there, let's take a look at some of our viewer emails. From Christoph in Atlanta, Georgia, it says, "How does a stretch IRA help save me taxes?" So, how does that work?
Congratulations for Christoph to know the language.
Right.
A stretch IRA allows the investor to pass that individual retirement account down to multiple generations and keep the tax preservation intact.
Somebody passes away, rather than having to take all the money at once, they can take a little bit at a time.
Correct. The tax rules allow for several different scenarios if enacted properly. There's a smart way to get the money out and a dumb way to get the money out. The dumb way is a 5-year or a lump sum payout. You pay all the taxes when the distribution happens. In the stretch IRA, if properly set up, it allows the successive generations to take out the minimum distribution, keep the tax haven intact. Obviously, less goes to Uncle Sam, more to compound in the account. Compound interest is what the 7th wonder of the world, 8th wonder of the world.
Now, there's some talk. I mean, I've heard some things, reading some journals that say that they're thinking about doing away with the stretch.
Right. Some of the laws that are coming out of Congress now could have different impacts on retirement accounts. Look, since the mid-70s, trillions and trillions of dollars have built up into these retirement accounts. That's the sweet spot for taxation on the United States of America. So if they change any of the rules and take away the stretch, it would likely have a 5-year distribution rule or a lump sum. If your son or daughter is a $100,000, $200,000 a year earner, and now all of a sudden they have to take their IRA dollars out in a lump sum, that puts them in the highest possible bracket, and Uncle Sam now is going to rob you of your life's work.
And so clearly, from that perspective, that's where estate planning and asset protection comes into play, to figure out these things, to say, hey, look, Christoph, it's entirely possible that you could get hosed here, and we need to do something different with the estate planning documents as well, to just try to protect it from that perspective.
Yeah, I mean, the rule is planning, just planning. I mean, anybody who's watching this, they should be thinking, I should be talking to somebody before these issues arise. There's so much we can do if we plan, whether it's asset protection, income tax planning, estate tax planning. I mean, that's the rule.
It all goes back to planning.
Yeah, you just can't sit around and wait for it to happen. And unfortunately, that's all too often what happens.
Right.
I know.
We're talking a lot about tax planning. And I think a lot of times people think, tax planning is not for me. It's only for the super wealthy, the mega rich. And I know that's not true. But for you guys, you guys are planners here in the Georgia area, in the Atlanta area. What's the right number? Who should be doing tax planning?
Well, I think anybody who's worked hard for the money deserves to have the best possible plan for themselves and their family. So in our practice, we give everybody the opportunity to come in for a consultation. It doesn't mean everyone fits with our firm, but I think anybody that worked hard for the money deserves to have the best possible planning for themselves and their family.
Absolutely, and with all the various solutions that are out there, not all the solutions fit all different all people in all different income classes. So in other words, there may be solutions that are just too expensive for somebody with a certain net worth, but there are certainly solutions for everybody out there.
So basically what you're saying here is that, look, everybody needs to be doing some sort of planning. It doesn't matter what your income level is, what your asset level is. You need to be doing planning, and the amount of assets, the amount of income is going to dictate the amount of planning, which makes perfect sense. Yeah. I mean, that makes perfect sense. So that as you're contemplating what am I supposed to do next, it really is, we've been talking about all along, have a plan, and have a plan includes, look, I don't care if I'm making $20,000 a year and all I need is a simple will, and quite frankly, you still have to have a power of attorney, and you still have to save for retirement, and you're still going to take money out, and the same thing holds true for somebody with $100,000 or $1 million. It all means I need to structure my income properly, it needs to be distributed properly, and my estate plan needs to be set up correctly, and quite frankly, if I own a business, I need to be thinking about how to protect myself and my business as well. So our second piece comes from Daryl in Lincoln, Nebraska. He says, can I leave my IRA to a trust? So how does that work, Greg? If Daryl passes away, can he leave the money to the trust?
The short answer is yes, and the long answer is it needs to be the right kind of trust.
Right.
Because there are certain trusts where if you leave the IRA to, it will, as Phil pointed out, be a dumb decision because it will cause the tax to be accelerated or be paid out over 5 years. Versus if the proper provisions and the proper planning is done with the right kind of trust, you can get the same effect as the stretch IRA and defer that tax for many, many years.
What I've seen is that a lot of times, if you have a trust that was created, say in the 80s and 90s and early 2000s, maybe up to 2008-9, there is no tax planning from that perspective to take care of the IRA aspect or annuities, qualified money. But I think that's something, if you're going to have a trust, if you have a trust in place, you certainly would want to have that reviewed to make sure that you have that tax language embedded in your trust currently.
I mean, stuff is changing all the time.
Right.
You need to have your trust reviewed regularly. I mean, the estate tax exemption has changed radically in the last 10 years. I mean, up and down and gone and then back and then exemption. I mean, so reviewing and planning, that's it. That's the secret.
Seems to be a consistent theme. Plan.
Yeah, but
plan.
the problem in that is most people don't go through the effort to plan, especially when it comes to the estate side. It's a difficult conversation. We're talking about one's mortality, and those are different, difficult conversations that a lot of people stay out of. So as an advisor, it's my fiduciary responsibility to drive the discussion with my attorney partners to do that.
And I think also one of the nice things about it is if you're going to be working with a financial advisor, if you're going to be working with an attorney, you want a group that is working together. Because it seems to me, you know, when I'm listening to the two of you talk about how the practice works and what you guys are doing, that you guys are paying attention and focusing on the same issues so that it's not a vacuum. Too often, I think what happens is you work with some big wirehouse broker, and he or she may be really good about putting your money in the stock market, but at the end of the day, when you ask them questions about either income tax planning or estate tax planning, sorry, it's not my job. You need to go talk to somebody. Right. Go talk to Greg, and unless Greg's working hand in hand, you have no idea if that plan's working in the right direction.
Right. Well, too many times there's no connectivity in a multiple, you know, multidisciplinary way.
Right.
It'd be like going into a football game and only having an offensive plan,
right,
and no defensive plan and no communication on how special teams and all three fit together. You just wouldn't do that.
And we can draft the most beautiful, well-crafted documents in the world, but if the assets aren't properly pointed to the various buckets, which is usually comes on the financial planning side, which means that we have to communicate, then that's a big problem.
Right.
Well, and look at how the true wealthy people of the world do it. They start a family office, and they literally create a point person inside that office. And that office handles everything. So there's coordination. So in effect, that's what you want. You want your own family office, which really means finding advisors that are already working together, that understand each other's piece of the puzzle and make sure it all fits.
So let's talk about some of the other issues that are out there. Let's talk a little bit more about the Roth IRA. I think people really like the Roth IRA. I think there's some confusion out there, but it certainly is a beautiful tax savings vehicle at this point.
IRA is a great creation. It's a great idea from the late senator that created it. I think that there is a lack of interest today from people converting to Roth IRAs. They don't want to pay the tax up front to make the conversion happen, or they don't know strategies to convert over a period of time. So from my perspective, I think the Roth has been really less utilized, less effective maybe as it could have been, and that's just positioning in the planning and in the strategies on the front end. But obviously, we were talking in the previous segment, if you had a list of assets, the Roth IRA is the most valuable asset you own. Why? Because it can go unencumbered currently by Uncle Sam. And if no tax is being taken out of that account, it becomes very, very valuable. The rules have changed. Some of the limits have come down. There's been more expansion of eligibility. But I think a lot of people are not paying attention to those rules.
So for old CSRS employees, they have what's called the Voluntary Contribution Program. And these guys are allowed to take 10% of their lifetime earnings. They go to HR, find out what 10% is, and they can put it into this account with the federal government. Sits there for about 30 days, they retire, and they're allowed to convert that account to a Roth IRA. So talk about a way to get $100,000, $200,000 into a Roth IRA never having had to contribute all along. It's just a phenomenal.
Employees only, right?
Federal employees.
So not the rules for us.
Not for the rest of us, just federal
not the
employees.
rest of us.
Not for the rest
like
of us.
Congress has a separate retirement plan. And health
Absolutely,
plan.
absolutely.
Yeah.
We're going to take a quick break here, but when we come back, we're going to go to our takeaways for the day. I'd like to thank each and every one of you for joining us today. It's been a great conversation. You're watching The Savvy Investor. We'll be right back.
If you have questions, drop us a line. Each week, our experts will address viewer mail, and you can email us your questions or go to our website, thesavvyinvestortv.com, and click on Contact Us. Interested in learning more about planning for your financial future? Join Michael Canet, host of The Savvy Investor and best-selling author, in person for an important, life-changing financial workshop on the following dates, and start taking control of your future. If you are ready to discover the financial tools and strategies that can help you build the retirement of your dreams, just call 1-800-787-SAVVY today to reserve your spot.
Most of us understand that planning is the key to retiring with the resources and benefits you need. Most of us also don't think about what would happen if a significant portion of these resources were taken away from us before we reached our goals. This can happen through a bad investment, a lawsuit, or even unintended expenses.
As the nation's leading asset protection attorney, this is the area in which I work. To protect the assets you've worked so hard to create so that they're there for you when you need them.
Call us today for a free strategy session at 800-787-SAVVY. It's not too late to start protecting your assets right away. 800-787-SAVVY.
Today we were joined by Phil Calandra. He's the co-founder and CEO of Calandra Wealth Management. Attorney Greg Jacobs, he's the managing partner with Jacobs & King, and attorney Doug Lodmell, he's the managing partner of Lodmell & Lodmell. They give us really great information on saving and reducing your taxes. The takeaways from today is: 1, have an exit strategy. Disinherit the IRS, not your heirs. Number 2, Warren Buffett pays less taxes than his secretary. By planning your income, you can plan and control your tax bill. Warren does it, so should you. And number 3, tax-free is better. You can help control your tax bill today and in the future. If you think taxes are going to increase, you may want to have access to tax-free income. Thank you again to Phil, Greg, and Doug for joining us and helping us make smart money choices. And thank you for joining us. We'll see you, the Savvy Investor, next week.
Call today to get your free guide to navigating taxes in retirement. Every retiree's goal, from our perspective, is to take the least amount of risk possible to accomplish your goals. Too often, financial advisors and stockbrokers assess your risk tolerance. Just because you can tolerate the risk doesn't mean you have to accept it. Remember, at the end of the day, it isn't how much you make, it is how much you keep. If you would like more information about today's topic, you can contact our offices or visit us on the web at thesavvyinvestortv.com. When you visit our website, sign up for our free weekly newsletter where we give you tidbits each week to help you make smart money choices.